How do you balance back from such a devastating blow? Is recovering even possible, or is your trading career over before it begins? If you've ever found yourself in this situation, don't worry, you're not alone. We understand how challenging it can be to regain your confidence after experiencing significant losses in the market. But fear not, because we will unravel the secrets of recovering from a significant trading loss in today's episode. We'll explore the psychological aspects, the practical steps, and the invaluable lessons that can turn your setbacks into setups for future success. So, without further ado, let's uncover the art of bouncing back from a significant trading loss. Here are the 7 crucial steps to help you recover from those trading losses in a volatile market. Number 1. Learn from your mistakes. This is where a post-trade analysis comes into play. After any trading experience, take the time to analyze what happened. Ask yourself questions like, did I miss something in my research? Did I let my emotions drive my decisions? It's easy to relate to these questions, especially if you've ever found yourself in a situation like our example. Let's take a closer look. Our example comes from when the global financial crisis of 2008 to 2009 was in full swing. The Federal Reserve was taking unprecedented measures to tackle the economic turmoil, including drastic interest rate cuts. At that time, our trader believed that interest rates would rise once the recession ended. However, reality had a different plan. The Fed started raising interest rates in December 2015, much later than expected. Instead of cutting losses and reevaluating the situation, our trader added to the position, stubbornly believing in the original assessment. The outcome? Repeated losses and a hard-learned lesson about the dangers of refusing to acknowledge when you're wrong. This experience serves as a reminder that emotions can cloud judgment and prevent traders from adapting to changing market conditions. What can we take away from this? First, emotions like fear and overconfidence can lead to bad decisions in trading, so it's crucial to stay rational. Second, after each trade, analyze what went right and wrong to keep improving. Lastly, flexibility is key in trading because markets change fast. To put these lessons into practice, keep a trading journal, seek feedback from others, and set clear rules to prevent impulsive decisions. Remember, even experienced traders make mistakes, but it's how we learn from them and adapt that leads to growth. Number 2. Keep a trade log. Imagine a scenario where you have a vast history of trading experiences to draw upon from 1999 to the present. That's exactly what our example trader does, a practice that has proven invaluable over the years. Our example trader maintains a comprehensive spreadsheet documenting every trade transaction over 2 decades. This log includes basic details such as order entry, exit dates, and realized gains and losses. But here's the kicker. A column is dedicated to personal thoughts on what went right or wrong in each trade. This log isn't just a record of transactions. It's a gold mine of insights. The trader frequently revisits it when evaluating similar trades or generating new ideas. What can we learn from this? First, keeping a detailed trading log is essential. It's like a historical record of your trading journey, allowing you to learn from your past experiences. Second, the real value of the log lies in the notes you make. These notes offer insights into your decision-making process, emotional state, and what you could do differently. Lastly, continuous improvement is the goal. By learning from past trades and applying those lessons to future decisions, you can become a better trader. To put this into practice in your trading journey, choose a method for keeping your log, like a digital spreadsheet, dedicated software, or a physical journal, and be consistent about recording every trade. Remember to include personal notes for each trade, such as thoughts, emotions, and lessons learned, as these insights will guide your decisions. Number 3. Write it off. This practice involves utilizing investment losses to offset capital gains and, in some cases, ordinary income up to $3,000 per year. Imagine an investor facing a significant loss in their investment portfolio. What might seem like a moment of despair can be an opportunity for financial optimization. What can we learn from this? First, you can use your investment losses to reduce your tax liability by offsetting capital gains, which is a practical way to recover some losses. Second, understanding the tax code and applying such strategies can be valuable for your financial plan. Lastly, knowing that your losses serve a purpose can provide some consolation and boost your morale during tough times. To implement this strategy, consult a tax professional as tax laws can be complex and change over time. Keeping detailed records of your investments, gains, and losses will make calculating and applying deductions easier. Additionally, consider the timing of your investment sales to optimize tax benefits by strategizing your portfolio. Number 4. Slowly start to rebuild. This strategy encourages investors to take a gradual approach, easing back into trading. Instead of jumping into large positions, consider smaller ones. The focus should be on accumulating small wins to reaffirm your trading strategy and, most importantly, rebuild your confidence. After a significant loss, it's wise to gradually get back into trading by taking more minor positions to reduce risk and build confidence. Second, focus on accumulating small wins rather than chasing big profits, as these successes can boost your morale and reaffirm your trading strategy. Lastly, adjusting the risk per trade is a practical way to protect your capital during recovery. To implement this strategy, plan your comeback by developing a clear design with defined rules and parameters. Monitor your progress by keeping track of small wins, which will help maintain your confidence and motivation. Most importantly, stay disciplined and stick to your risk management plan, avoiding rushing the process, as patience is your ally during the rebuilding phase. Number 5. Scale up and scale down. This strategy emphasizes trading in increments, whether it's scaling up or purchasing more shares over time, or scaling down by selling in smaller increments. The goal is to limit risk and maintaining a flexible trading strategy. For instance, when considering a new position, an investor might start with 20 shares and gradually increase their holdings, especially when the price dips. Conversely, when selling a winning position, they may scale down by selling in 10 or 20 share increments, especially if the stock is still climbing or has reached their portfolio's position threshold. Here are the main points we can learn. First, incremental trading, whether scaling up or down, involves making more minor gradual changes in your trading positions. This approach provides better control over your investments and lowers risk. Second, effective risk management is vital when trading in smaller increments to protect your capital. Lastly, the flexibility of scaling up or down allows traders to adjust to evolving market conditions and stock performance. To put this strategy into practice, set incremental buying and selling targets based on your risk tolerance and portfolio strategy. Regularly evaluate the performance of your positions and make adjustments as needed, such as adding more shares or gradually selling. Additionally, stay informed about the market, news, and the specific stocks in your portfolio, as this information will guide your incremental decisions. Number 6. Use limit and stop orders. Here's a quick reminder of how limit and stop orders can improve trading discipline. Limit orders let you specify the highest price you're willing to pay for a stock or the lowest price you're ready to sell at, while stop orders execute as market orders once a specific price level is reached. The key takeaways are that these orders help control emotions by forcing traders to stick to predetermined entry and exit points, maintain discipline in trading, especially when selling for a profit or cutting losses, and manage risk effectively. To put this into practice, set clear limits and stop order targets before entering a trade, ensuring they align with your risk tolerance and trading strategy. Continuously review and adjust these orders based on changing market conditions, and stay informed about the market, news, and your portfolio to guide your order decisions. And number 7, get a second opinion. Seeking insights from professionals who think differently about the markets can be a game changer. Seeking a second opinion means getting different perspectives and insights, which can enhance your understanding of the markets. Experienced professionals can provide valuable guidance to help you make informed decisions and avoid costly mistakes. Feel free to connect with financial professionals there to assist you in the complex world of finance. To apply this strategy effectively, approach second opinions with an open mind, be ready to consider different viewpoints and techniques, ask questions for clarity, and make it a habit to regularly consult with financial professionals, especially when facing significant investment decisions or life changes. Collaborating and sharing insights in finance can lead to more informed choices and financial success. Getting a second opinion empowers investors to make better informed decisions and navigate the complexities of the financial world. And there you have it, folks, the 7 crucial steps to help you bounce back from those trading losses in a volatile market. Embrace these strategies, apply the practical tips, and make them a part of your trading routine. Thank you for joining us today in Stock Market Callus. Check out more videos about Millionaire Making Blueprint. Keep buying dividend stocks and double your money with these 6 investing hacks. These videos will provide you with valuable insights into effective strategies and enduring principles that have the potential to significantly increase your wealth and steer you toward achieving financial self-sufficiency. Until next time, see you!